Leasing business equipment is one of the smartest ways Canadian companies can save money, protect cash flow, and stay current with the tools they need. Instead of tying up capital in an expensive purchase, you make predictable monthly payments and often have the choice to upgrade or even buy the equipment at the end. So, what exactly is equipment leasing? It's a financing arrangement that allows your business to use equipment without owning it outright. You spread the cost over time, and in many cases, you still have the option to purchase at the end of the term. Why does this matter? Because leasing helps businesses manage their cash flow, avoid large upfront costs, and keep up with fast-changing technology. Whether you're in construction, healthcare, transportation, or tech, leasing is designed to make equipment more accessible and finances more manageable. Now, there are different types of lease agreements in Canada, and choosing the right one can make a big difference. A capital equipment lease is long-term and looks a lot like ownership. The equipment usually shows up on your balance sheet as an asset, and at the end of the term you can buy it for a small amount, often just $1. This is common for heavy machinery, manufacturing assets, or transportation fleets where long-term use is expected. A sale and leaseback agreement is another option. If you already own equipment, you can sell it to a leasing company, free up cash, and then lease it back so you can keep using it. This is popular with manufacturers and transportation firms who want to unlock funds for expansion or working capital while still holding onto their equipment. Then there are residual leases. With this type, the leasing company assumes the equipment will still have value at the end of the term. That means your monthly payments are lower because you're only paying for the use of the equipment, not the full cost. This works well for assets like vehicles, technology, or construction equipment that keep a predictable resale value. And for businesses with seasonal revenue, there are seasonal payment leases. Payments are structured to align with your busy months while being lower or even skipped in the off-season. This is common in industries like agriculture, landscaping, hospitality, and construction. So, what are the big benefits of leasing compared to buying? Leasing lets you spread out the cost with lower upfront payments. It gives you predictable monthly expenses, helps with budgeting, and often comes with easier credit requirements than loans. Many lease programs also include maintenance, which turns surprise repair costs into simple fixed payments. Now let's talk numbers. Lease rates in Canada usually fall between 6 and 16%, depending on your credit. Terms typically range from 2 to 5 years, and upfront costs are usually minimal, often just the first month's payment and a small deposit. At the end of the lease, you may have options. Buy the equipment for as little as $1, pay fair market value, renew the lease, or simply return the equipment. Eligibility for leasing is generally more flexible than a bank loan. For smaller deals, lenders may check both personal and business credit. Larger deals may require financial statements or guarantees. But since the equipment itself serves as collateral, approvals can be quick, sometimes instant, and often within just a few hours. Documentation is simple, and funding is frequently same or next day. Leasing is not one size fits all. Companies like Jacova Financial customize solutions to match the needs of different industries, whether that means flexible payments, seasonal structures, or the ability to finance both new and pre-owned equipment. At the end of the day, equipment leasing is more than just financing. It's a growth strategy. It preserves cash for other business needs like hiring, marketing, or expansion. It helps companies keep up with technology, upgrade equipment on schedule, and act quickly on opportunities without waiting for lengthy bank approvals. For Canadian businesses, equipment leasing is about turning financial limitations into opportunities. It gives you access to the tools you need, keeps your cash flow strong, and supports long-term growth in a practical, predictable way.